Let's begin our analysis by examining the daily chart of SPY, showcasing the broader picture of the S&P 500's recent performance. Immediately, we notice a noticeable downtrend in the past few weeks. The price has consistently dipped below its 50-day moving average, suggesting a weakening of the bullish sentiment. The current price level is near a critical support zone, around 440, which has previously acted as both support and resistance. A break below this level could potentially lead to further downside, but holding above it could signal a rebound. This support zone coincides with the recent news about the U.S. stock market experiencing its worst week in nearly 18 months due to economic concerns stemming from a weak jobs report. This data aligns with the downtrend observed in the daily chart, indicating a potential correlation between economic news and the S&P 500's price movements. To gain a more granular perspective, let's switch to the 1-hour chart, focusing on the recent price action. Here, we see a series of lower highs and lower lows, a telltale sign of a bearish trend. However, there are some potential bullish signs emerging. The price has bounced off a support level around 445, which coincides with the 200-day moving average. This suggests that some buying pressure is present, potentially pushing the price higher. Also, the recent dip has created a potential bullish engulfing pattern, where the current candle is fully engulfing the previous one, indicating a potential reversal. This positive price action aligns with the news of futures tied to Wall Street's main indexes rising on Monday, signaling a potential rebound after last week's losses. Now, let's zoom into the 15-minute chart to analyze the most recent price action and identify potential short-term opportunities. On this time frame, we see that the price is trading near its 20-day moving average. This moving average is acting as a support level, preventing further downside. The price has also formed a bullish divergence on the RSI indicator, indicating a potential rebound. This divergence suggests that the selling pressure is weakening and the price could potentially rise. However, it's important to note that the recent downtrend has created significant resistance around 450. Breaking above this level would be a strong bullish signal, while failing to break through it would likely result in further consolidation or even a continued downward trend. Zooming back out to the 1-hour chart, we observe that the price has recently broken above the 200-day moving average, a significant bullish signal. This breakout suggests that the overall trend is shifting from bearish to bullish. Furthermore, the price has formed a potential double bottom pattern, which could indicate a reversal. This pattern requires the price to break above the neckline, which is around 450. A successful breakout above this level would validate the double bottom pattern and confirm a strong bullish reversal. However, if the price fails to break above this neckline, the bearish pressure might remain dominant. This scenario would suggest that the recent rally was simply a temporary bounce, and the price could potentially resume its downward trend. Looking back to the daily chart, we can observe that the price has held above the critical support zone around 440. This suggests that the bullish sentiment is still present and the S&P 500 could potentially rebound. However, the price is facing significant resistance around 460, which coincides with the recent highs. Breaking above this resistance level would be a strong bullish signal, potentially leading to further upside. However, failing to break above this level would likely result in a pullback or even a continued sideways trend. The upcoming inflation reports on Wednesday and Thursday are likely to play a crucial role in determining the direction of the market. As we wrap up our analysis, we can identify some key price levels to keep an eye on. The most important support level is around 440, which has previously acted as both support and resistance. A break below this level could lead to further downside, while holding above it could signal a rebound. On the other hand, the main resistance level is around 460, which represents the recent highs. A break above this level would be a strong bullish signal, potentially leading to further upside. The market's direction is likely to be influenced by the upcoming inflation reports, with a positive surprise potentially fueling a bullish rally. If the reports are unfavorable, the S&P 500 could continue its downward trend. Furthermore, The Federal Reserve's upcoming policy meeting and their stance on interest rate cuts will have a significant impact on the market sentiment. Therefore, monitoring these key price levels and closely watching the economic data will be crucial for navigating the market's volatility in the coming weeks. Remember, this analysis is for educational purposes and should not be considered financial advice.